This is our Forex blog for September 17th, 2012. I had a busy weekend and I forgot to load this last night. Our currency meter works live, so when I brought it up this morning, I left it running. Basically, one of the first steps of our easy three-step Forex trading system is to use this currency meter and simply look to buy the strongest currency or currencies versus the weakest and sell the weakest versus the strong. You can sort this. I like to sort it by the hourly trend, and then you can spot the currencies that are strongest: the pound, the dollar, Swiss, euro, and the weakest: Australian, CAD, and yen. So obviously the pound was very strong real time, 15-minute trend, hourly, daily, weekly, monthly. The Australian was one of the most consistently weak today. This is not one of the saved currencies that we go over each day. Most people probably don't trade the pound Australian too often, but today was, the day most likely to trade this. So when you have a pound that's very strong and Australian that's very weak, you tend to have, moves like this, and that's exactly what happened. Very strong trend. This is a 5-minute chart. You can also bring up a 5 pips per bar chart, which I feel, gives you a lot more clean signals. Basically, look for an uptrend and draw your trend line over the bar's high and wait to buy. You can also buy sideways rectangle breakouts like this. Here's a decent 4-bar pullback. Here's about a 5 or 6 bar pullback. And anytime you have a strong trend, 4 to 6 bar pullback followed by 1 green bar up, you buy it when it goes 1 pip above the high, and usually strong trends will work their way up to the Fibonacci profit target, which in this case would be right here. First and second fib target pretty much touched the second fib target to the pip, and that was the end of the move. So that's one example today. So the first step is to identify the ones most trending and then buy the strong versus the weak. You can see the CAD was relatively weak at 1 o'clock here. All the time frames are down. What was one of the stronger trends at that time? It would have been the dollar. So basically we want to buy the dollar CAD. So let me bring up this chart. And first thing, in looking at this, you can see the point of control for the previous week. This is where most traders last week had their positions. And typically underneath that area, you want to look for sells, and above that area you want to look for buys. This is a value area high, which is where basically the market spent 68% of its time last week, from the upper value area high to the low, wherever it is off the chart here. And you can see it acts as major resistance. Both these levels act as resistance. Once they get broken, they tend to act as support. And then you can see with the real-time trend here, there's a lot of different ways to find entries. I like to look for 3 to 6 plus bars pullback. First green bar, you buy. You can see this move up here had a lot of statistical strength. The pullback started off with a little bit of weakness and then it disappeared. That's a very high probability trade. You also have this pullback right here, which is also kind of like a little wedge pattern. A lot of times volatility that's high gets smaller, and when it breaks out of the wedge, you can see it just exploded. And if you used our trailing stop to get you out, you would have been in this at 21 and out at around 51. So a nice 30 pip move. The real key to trading is small losses, big wins. That's really the only secret. Now remember, I only left this running from around 9. So the yen, the longer time frame trend was down. Today it was showing, counter trend strength. You can always trade with the real-time trend strength, but it's in your best interest in the higher odds when all the time frames, or as many of them, line up as possible. So the dollar, as you can see, is strong. The Australian was also weak, just like the CAD, so you can sell the Australian dollar, and you can see this is underneath the hourly. It's underneath the point of control of last week. Some of the trades that I think I would have taken is this pullback right here. That didn't really generate too much of a profit. This pullback right here worked. You always got to have a little bit decent pullback, 15, 25 pips. So this little move right here is not enough of a pullback for me, but this one here would be. This is right on the verge of what I would consider a decent pullback. A lot of times currencies that have, are right near our lower bands are going to make at least a two-wave up move. So just by simply waiting for it to try to go higher and failed, it really never made a significantly higher high and started to go back down. That's a trade there. That's a pretty high probability trade. This one right here, right there. And again, when it's near the lower bands, this is a very low odds of the trend continuing. So wait for a decent pullback like this. Get short somewhere around 105.05, and you can see our trailing stop got you out of this at around 62. You'd be short somewhere around the whole number. You made about 40 pips on that trade. And again, the key is small losses, big wins, and it doesn't. A lot of new traders only care about what the winning percentage is. But I've seen traders that have had 90% winning trades because they take 2 or 3 pips every time, and one loss can wipe them out. If you take 100, 200, 500 pip loss, which can happen with these long trends. What if you were short the euro dollar for the last 2 weeks? You would have got killed. And that's what tends to happen to new traders. Don't worry about being right. Worry about catching big wins and minimizing your losses to the smallest possible. Now, you can see the histogram on the bottom shows you the real-time trend strength. Some traders prefer to use the colored bars, and there's many different shades of red and green. The darker the green, the stronger it is. You can see this pull back a little bit of strength right here. The strength lessened, you go short, and the bars start getting red, which means you want to hang on to that trade. First green bar, you're out. It's a very intuitive way of trading. If you were going to try to buy the low right here near the lower bands, it goes green, you get long. Here's your first red bar, you put your stop a pip underneath that low, never went underneath that, continued up, starting to lose its momentum. Maybe you would have got out of the trade here at 02. You would have been in this around 95, 96. Not the biggest profitable trade in the world, but it is a counter trend trade. So some traders prefer to use our colored bars versus the histogram.